Hi and welcome to the Trading Bell Show. I'm seated with Dr. Habil Olaka, the CEO, Kenya Bankers Association. We want to understand the state of the banking industry this year till where we are, and of course some of the latest happenings in the industry. So, Dr. Habil, allow me to start with the news yesterday. Central Bank increased, which people are seeing it as a surprise, by 2% to 12.5% in the benchmark rate. And Kenyans are worried. When you look at the headlines today, quite a bit alarming. Kenyans are worried, how will this affect the outlook of the banking sector, and what adjustments should we expect moving forward in the banking sector, please?
Yeah. I think the increase in the policy rate was not a surprise. What was a surprise was the magnitude of the increase.
Yes.
So because you see, Central Bank has got a mandate to ensure that there is price stability, and by price stability means you have got to tame inflation, and also you have got to keep the exchange rate stable.
Yeah.
Now, from those two perspectives, if you look at, for example, the inflation, there was quite a bit of pass-through inflation that was coming through the exchange rate, and especially on the fuel. Yeah. So you get that the fuel inflation was on the rise, partly because of the deterioration of the exchange rate.
Sure.
And then two, we have got quite a bit of foreign denominated debt on our country's balance sheet, so to speak.
Yeah.
And that foreign denominated debt, when you convert it into shillings in an environment where the shilling is depreciating, you find that there's quite a bit of a build-up in that debt. And so our path towards fiscal consolidation is significantly threatened.
Sure.
And so I think the move by Central Bank, if you look at the rationale that they gave for making such a surprise move, was partly influenced by the two. The fact that they are trying to tame inflation, which is coming from the shilling depreciation on the fuel, and then they are also trying to tame the depreciation of the shilling.
Yeah.
You see, what tends to happen is that when the foreign markets tighten for they're taming the inflation from their point of view. Yeah. They tighten, and therefore the interest rate starts increasing in those markets. Yeah. They tend to draw funds from the developing world into those markets. Now, the only way you can be able to attract some of those funds back is by increasing your rates, so that you can then be attracted to come into the market. And I think that's what Central Bank is trying to do. Okay. Trying to reverse that outflow back into the economy. Yeah. And you see, in a market where the shilling is depreciating, when the reverse occurs, where the flows start coming back, then shilling starts gaining strength. Yeah. And you can be able to achieve that dual objective of fighting inflation, at the same time keeping the exchange rate stable.
So what adjustments should Kenyans expect? Because people are having accounts, people are taking loans, and now this has been announced.
Yeah, now I think it definitely creates some challenges. Yeah. You see, the banks will respond first of all by the fact that with the policy rate going up, the deposits will become more expensive because there's a tighter market, and therefore they have got to compete for those deposits. And in a tight environment, you've got to raise your deposit rate. So the deposits become expensive, and as a matter of the business model that banks have, they'll pass through that increase on the deposit rate into the lending market. Yeah. Now, when you increase your lending rates, there are two things. Yeah. One is the fact that the credit flow reduces because the demand for the credit is reduced by virtue of the fact it becomes more expensive. But the bigger impact is on the quality of the asset. Because what happens when the interest rate goes up, the probability of the customer being unable to start to service that loan increases. And so you start seeing the quality of the portfolio deteriorating. You see the non-performing loan portfolio beginning to edge upwards. And you're seeing that already, because if you look at the data that was released by Central Bank, in August, the non-performing loan portfolio was 15%.
Sure.
Come October, it has actually gone up to 15.3.
You're right.
And the trajectory is upwards. So we are seeing a continuous deterioration of the quality of the portfolio. Yeah. And that then creates a challenge to the bank, because when the quality is deteriorating, it means that you have got past provisions, for example.
Absolutely.
To ensure that you cushion yourself against any potential losses. Yeah. And then two, when that happens, then it means that the buffers you have built up are used up from your ability to be able to face any challenges that come up in the market.
Yeah.
So it's an environment whereby banks will then pull back in terms of their lending to the market.
Yeah.
And then too, they'll also be worried about their own asset quality. And in a market where there's no lending going on,
yeah,
things stagnate.
You're right.
Economic growth is challenged. And so until we come out of this situation where banks again start lending,
yeah,
then we hope to see some uptick in terms of economic growth.
Okay. You know, let me take the seat of the customer who probably has a loan. Definitely the one considering a loan now will definitely have to, you know, take it up with the increments that each bank will decide to take it up to. But for the ones who currently have loans, what does that mean for them?
Well, there are a number of options.
Yeah.
One is the fact that the banks will pass through that rate increase because it's part of the expectation of central bank.
Yeah.
The fact that they'll pass through as part of the monetary policy transmission mechanism into the credit, into the lending. So the loans become more expensive,
sure,
and therefore the interest rate that the customer is paying
will be passed to them,
goes up,
yeah,
and therefore the installment that you're paying will also go up because now the interest element of that has actually gone up.
Yeah.
What then happens is that the customer is actually hit twice. Mark you, we are having a challenge in terms of economic growth.
Yeah.
So the performance of the business is suddenly struggling because of the economic environment that you're operating in.
Yeah.
So one is that your cost of loan is going up. The installment you're supposed to be repaying is actually going up.
Yeah.
On the other hand, your cash flows in terms of generating from the business is actually going down.
Yeah.
So you're hit twice, from the cost side and from your revenue side. Now, in that kind of an environment, what I'm seeing is that most banks actually do sit down with their customers.
Yeah.
And they do then do what we call restructuring of the facility. So
yes,
an installment that was, say, 15,000 for argument's sake.
a month, yeah.
And because of the interest increase, it goes up to, say, 17,000. Now, what you can agree with the customer is to reduce the installment back to 15, but extend the maturity period so that you'll pay it for a bit longer, but you're still paying the same installment that you're paying before the interest increase. And that's that's a discussion that you normally have with the customer, and put him at a place where he's comfortable, and therefore you're also ensuring that that facility does not deteriorate into non-performing.
You're right.
So you're actually doing it for your own interest as well.
So it's good for negotiations. You touched on the NPLs, the non-performing loans, and I'm curious to ask, do you think the loan impairment provisions, right back that we saw in financial year 2021 and 22, we saw that happen. Do you think it happened too soon for the provisions that you brought in, given the trend of increased provisions in the 9 months that we have seen so far in 2023?
Well, you see, I think the two of them are for different related periods. You see, at that point in time, it was mainly because of the COVID challenge.
Yes.
And you then assess the likelihood of the facility going bad, and on the basis of that, you pass provisions, you book provisions, just to ensure that you cushion yourself against the probability that this asset will deteriorate and therefore be impaired. Now, at the end of the period, you may discover that you are taken to a pessimistic view of the possible performance of the customer. Now, and for at the end of the period, you find that the customer has actually done much better than you had actually anticipated. So you're taking in more provisions that you actually require, and therefore what you do, you release those provisions back. And that's why you see those write-backs of the provisions. However, in the current period, completely unrelated, because this one is arising out of the fact that one is we are coming out of a depressed economic performance period, especially during the electioneering period. And then we also have the geopolitical developments in terms of the Ukraine war. There is currently the Gaza, Israel war as well. And then the fact that because of those geopolitical tensions and what's happening in those other markets, we find that it's affecting our economic growth as a country. And therefore, the view you take about the customer today
Yeah.
is based on the current circumstances. And
Right.
so given that you're seeing a fairly bleak future,
Yeah.
given what's happening, in terms of the economic
Geopolitical.
developments,
Yes.
you then take a view and take provisions.
Okay.
So they are actually taking provisions based on what is developing in the market, what their view is in terms of the way forward. Because when you see the tensions, things are not coming down.
You're
Things
right.
are, on the other hand, beginning to escalate. People are taking hard stance positions.
Yeah.
Because of that, now you know that you are likely to continue facing this hard, challenging period.
Sure.
So you take provisions for that.
Okay.
Yeah.
Let's talk about the exchange rate, and I'm curious to understand from your position. There has been sentiments that, well, we are now stabilizing, we are getting to probably that level. And I wanted to understand from your end, the current measures in place, do you believe they are adequately addressing the issues, and are there further steps required to stabilize and mitigate fluctuations?
I think to an extent, yes,
Okay.
because of the fact that, for example, if you check, we've just discussed about the Monetary Policy Committee decision,
Sure.
where the rate was hiked by 2% to 12.5%.
Sure.
And one of the reasons behind that was in view of what's happening in the forex market, because of the fact that the shilling is depreciating rather rapidly,
Yeah.
and therefore affecting our debt position, and also inflation from fuel inflation from point of view. They have sort of like taken that position to anchor the inflation expectations,
Yeah.
and therefore also support the fact that the shilling is depreciating. Therefore try to change the costs
Yeah.
of the shilling in terms of depreciation.
Yeah.
Now, that decision, as much as it looks aggressive, I think it will be a good enough pointer to the market of the fact that things should reverse.
Sure.
From that point of view. But I think that will not be enough. I think for us to achieve that stability, we have got to send to the market
Yeah.
the message that the shilling has reached its true value.
Yeah.
And therefore, those who are holding on to the shilling who don't need it, or rather, those who are holding on to the dollar, who
Yeah.
don't need it, can release it to the market because they know that the market is going to give them the actual, true exchange rate
Yeah.
for the shilling. And also those who are going into the market buying for future needs,
Yeah.
when they don't need it today, and therefore causing some significant shortage of the dollar in the market, will not now go into the market to buy it today because they believe
Yeah.
that the shilling is rightly priced
Okay.
today, you see. So I think once the market believes that the rate is the true exchange rate,
Yeah.
then you'll see the market behave accordingly,
Okay.
and let the shilling be, the dollar be for that matter, and therefore float and be priced at the right price.
Okay.
As long as the market believes that this is not yet
Yeah.
there, you'll still see this, this tendency to hold on to the dollar until you believe that it has reached its true value.
All right. I know we have touched on some of the things I'm about to ask you, because I know you featured them in your report, because you just released the State of the Banking Industry report, I think 3 months ago. So just wanted to see, is there any other key finding or highlight in that report? I know there's quite a number, but from what we discussed and what is current, any other key findings you want to share, one or two?
I think one of the things that comes from that report was just the fact that I think the banking industry has shown the resilience that is known for, and demonstrated the fact that I'm anchored on two major key components, and one of them is actually the adequacy of the capitalization of the banking sector.
Yeah.
The banking sector has generally operated above the regulatory thresholds.
Yeah.
Over the period throughout, and in terms of the liquidity, they are also very well, very well placed in terms of the liquidity that they are holding. So from those 2 points, I think the resilience has shown. Okay. Shocks have come, but you have been able to weather through the shocks, be it COVID, and currently the current economic challenges because of geopolitical developments. I think we are well placed to wade through those challenges.
Let's talk about the latest trends that I've seen. I mean, looking at your year, I think you have had several mergers happening even the previous year. So there's a lot of mergers and acquisitions. Of course, not just here, we also seen our local banks doing the same in the regional sectors. And it's quite prevalent, which is good. but I actually wanted you to tell me whether this is good for the market or not. And I think I wanted to mention an example, SMEC, taken up by Hope. I also saw Credit Bank by Showcap and all. I was curious to ask you, I see microfinances and some of our, shareholding being taken up by, what we call foreign investors, if I may call them that. But of course, there's also a balance because I've seen our local banks as well take up some regionally. What does this indicate for you as a CEO and looking at all these banks? Is it just normal market players coming into play, or are there concerns?
I think concern certainly no, because it's a good sign, it's a good development. See, what tends to happen is that, and as I mentioned a little bit earlier, for banks to withstand the shocks, they need to have some things in place. And one of them is capital. So they should be adequately capitalized to be able to withstand any shocks that come into the market. We have got things like asset quality that also become handy in that kind of an environment, but also the liquidity. Now, the bigger the bank, the more likely it is that you have got adequate capital to be able to withstand the shock. So the bigger you are, the more likely it is that you've got adequate capital. Not always, but in terms of the adequacy of the capital based on the asset book you're holding. So the bigger the bank, the more likely it is that it's got adequate capital. And then the other thing is the fact that for liquidity, you see, banks leverage on their size or their branch network to be able to pick deposits from wherever. And so you find that, for example, the Kenyan market, the bigger banks have got no problem in terms of collecting deposits. And especially the current accounts which are almost like cost-free. So they really leverage on that size to be able to pick cheap deposits from the market, and therefore they then use it to their advantage. Now, the smaller you are, the more likely it is that you'll be having challenges on the very same things that I've mentioned.
You're right.
To see. So it will therefore make sense for you to combine with another entity, and therefore become a bigger entity, and therefore be able to have a chance to withstand the competition in the market. So be it in terms of your capital adequacy, or be it in terms of your asset quality, or be it in terms of your liquidity levels. Those are, so to speak, ammunition that you use for purposes of competing in the market. And the bigger you are, the more likely it is that you'll be able to compete in a much more, you'll be much more competitive in the market.
Absolutely.
You mentioned something about Kenyan banks moving into the region. And that's being driven by two things. One is the fact that, as I mentioned a little bit earlier, the size matters. And so you want to exploit the opportunities that are arising in the East African community market. And so you want to expand yourself into markets that are looking attractive for you to be able to perform better. And that's why the markets like, for example, in DRC, markets like South Sudan, of course it has got its own challenges, but the other markets of the EAC, the Kenya, the Uganda, Tanzania, they are fairly attractive for Kenyan banks. So in terms of expansion, those are the markets to target. You see, but then there's another factor as well that is motivating Kenyan banks to go into those other markets. You see, the East Africa now is a community, is the same. So you'll find that actually you have got your customers who are operating from Rwanda, your customers who are operating from Uganda, from Tanzania, from Burundi, some of them from DRC all the way coming this way. Now you want to move closer to the customer. So you then open operations where the customer is. And that's why you see this expansion into those markets, because banks are chasing their customers into those markets.
I see that. So two-part question as we come towards the end of the conversation. The central bank yesterday, I mean, the governor was on record in Parliament saying that we have a lot of unregulated, mobile credit, who are already operating, and that was quite a shocker. And I'm sure for you, sitting on behalf of the banks, that should concern you. I'd like to hear your comment on that, but also comment on the fact that CBK as well raised the transaction limit for mobile money, citing increased financial inclusion and support for business limited by mobile money. So how are banks responding to these changes? Of course, vis-a-vis with what we are seeing the central bank talking about, the regulation aspect of some of these offers.
I think first on the issue of the digital lenders, in the market, I think one is that the digital lenders are already in the market,
They were, yeah.
Before regulation caught up with them.
Oh.
You see, they're already operating.
Okay.
So it's not like, the regulator is already there, and therefore anybody who comes into the market has got to get licensed before you can start operating. They're already operating.
Yeah.
And then the regulation was changed by allowing central bank to have powers to actually regulate them.
You're right.
And so the first step was to ask those who are operating to actually apply for licensing.
Yes.
You see, and then you are given time within which you're supposed to, apply for the registration, or else if you don't apply, then you have got to cease operations.
Yeah.
And then there are those who are now coming onto the table after the regulations are in place, and therefore they have got to first of all get licensed before they can start operating.
Yeah.
You see. Granted,
yes,
in that kind of a scenario, you'll get that there will be quite a number of players who are already in the market who are fearing the conditions that central bank gives, and therefore they still operate underground.
Yeah.
You see, and then there are also the newer ones who are coming in and seeing the regulation, and therefore preferring to operate underground. And those are challenges that I think we'll have to face as we go along until we finally bring all of them into, because there's got to be a way in which anybody operating outside the regulatory framework is punishable.
You're right.
You see, and normally some of those guys is very difficult to reach them, but eventually they'll be reached. Yeah. But having said that, I think the critical thing was the fact that it was the right step in the sense that there were a number of challenges that were coming out of these digital lenders, and that blame was actually being put on the banks, because the banks were being seen. Anybody who borrows knows that I've borrowed from a bank. You do not know that you're borrowing from a money lender who is not registered anywhere.
That's
true. But when the blame comes, it's sort of like the banks are seen to be, the ones who are at fault. A number of malpractices, some exorbitant interest rates were being charged, some uncouth recovery processes that were being followed by these people. In terms of, confidentiality in terms of the information, you get, information flying all over the place. And those were malpractices that banks were suffering the wrath of without being the ones involved. So with the now regulator coming in and raining on them and trying to bring them under some order, for us it's a very positive development, because now we are all operating under some sort of like framework, and any misbehavior can easily be pointed out, and therefore you can be picked out and appropriate action taken for correction of the action. I think so. That's a good development. On the other point that you raised about the increase in terms of the limits, and therefore, the evolution of mobile money has got a positive effect on the banks. Because banks were able to leverage on mobile money to be able to provide mobile banking. You see, so like for example, right now, if you pick on M-Pesa as an example, a number of banks are actually into partnership with M-Pesa to be able to ride onto the M-Pesa platform to provide their lending services, their various banking services. So they are actually operating in unison. You see, now when the limits on how much can be transferred through the mobile money is increased, it therefore means that actually the bank can be able to transact through that channel with big amounts, you see. So for example, now you can disburse the full loan on an M-Pesa platform.
You're right.
You see, initially you either had to break it into bits and disburse first disbursement, second disbursement, third disbursement for you to disburse the full amount. But now you can be able to leverage onto the M-Pesa platform and disburse the full amount to the customer without any problem. The only challenge that comes in is on things like, for example, the money laundering and countering financing of terrorism. Because you see, the controls that banks go through from a regulatory point of view are adequate to provide comfort of the fact that it's not porous to money laundering and financing of terrorism. Now, the nature of mobile money is such that you cannot have those very detailed checks and controls that you're supposed to have, like you have in the banking sector. So, and that's why sometimes you have got to be careful on how much limit you put there. Because if the controls are not as tight and you're putting a very high limit, it can easily become an avenue for financing of terrorism
Yeah.
and money laundering.
Yeah.
So money is laundered from the economy and passed in through the mobile money, and because of the weak controls, you've got no control over it, you see.
Wow. Yeah.
Whereas you've got enough controls in the banking sector, it's unlikely that money will be laundered and pass through the banking sector without being detected.
Okay.
But it can pass through the other system.
Yeah.
It won't be detected. So
Okay.
it's a balance that you have got to strike.
Okay. And we seriously applaud the movements. Finally, you know, we cannot close our eyes to what's happening globally, and we have seen solvency events in the global banking sector, sometimes which are quite alarming. You hear news in other countries and what is happening. Is it time from your end that we increase the minimum capital requirements for local banks just to be safe, and bearing in mind that our local banking capital requirements are still, you know, lagging our EAC neighbors who have recently increased their sector minimum tier 1 capital requirements?
Well, you know, it's a debate that has been with us for quite some period of time.
Yeah.
There is the issue of the fact that when you increase the capital requirement for a banking institution, there are some banks, for example, that will just not be able to meet it.
Right.
Therefore, they either have got to close or combine, as we were talking about earlier, combine with others to meet that capital requirement, or some form of combination.
Yeah.
Now, those specific banks that are operating in that zone, they also serve a particular purpose. They also have their own niches that they serve.
Okay.
And those niches cannot be served by the larger banks. So it's a decision you've got to make. You either want to cut those niches off, and the risk you have is that they'll then go underground and not go through the formal channel. And informality is one of the biggest risks that we have. Informality breeds things like money laundering and financing of terrorism. There are also other risks, like, for example, tax evasion, all those challenges.
You're right.
And you would rather have money flowing through the formal channels than the informal channels.
Absolutely.
So it's a decision you make. You want to have strong, well-capitalized banks, and therefore increase the minimum capital, well and good. But on the other hand, you are shutting out those smaller ones, and those smaller ones serve a particular niche, a particular market, a particular need in the market, which then will not be served. And so it's a balancing act you have to make.
Dr. Habil, thank you so much for your time.
Thank you.
Very well.
Yeah.
There you have it, Dr. Habil Olaka, the CEO right here at Kenya Bankers Association. Very optimistic that we are at a good place and looking forward to an even better future. Thank you so much for your time. I leave you now with the markets.